You had a 78% win rate on demo. You were making 10% a week. Every trade felt easy. Then you opened a real account and everything fell apart. Not because the market changed, not because your strategy was wrong. Something inside you broke. And today we are going to figure out exactly what it was. 90% of traders who are profitable on demo blow their real account within the first 3 months. This is not a rare story. This is almost everyone's story, including mine. I was a god on demo. Calm, patient, strategic. I followed every rule. Then I put in real money and I became a completely different person. So what happened? What is the actual mechanism that turns a demo god into a real money disaster? The answer has nothing to do with trading and everything to do with how your brain processes real risk. Today I'm going to break this down scientifically. By the end of this video, you will understand exactly what changes. And more importantly, you will know how to fix it. Let us start from the beginning. Why does demo trading even exist? Demo accounts were created so traders could practice without financial risk. You learn how to place orders, set stop losses, and read charts. The mechanics, the basics. But here is something nobody tells you. Demo is not a simulator of trading. It is a simulator of trading without consequences. You discover that Eurodollar moves in predictable patterns at certain hours. You start recognizing setups, double tops, bull flags, support and resistance levels. Week after week, your demo account grows. You start feeling like you understand this. Let me ask you something. When you were on demo, how did you feel when a trade went against you? Probably annoyed, maybe a little frustrated, but not scared. You clicked close. You reset. You tried again. That is the first clue to everything we're about to unpack. On demo, a $200 loss is just a number on a screen. Your heart rate does not change. Your breathing stays normal. You stay rational. You can look at the loss, analyze it coldly, and make a better decision next time. This is why demo traders are often so disciplined. Their prefrontal cortex is fully in control. The prefrontal cortex is the part of your brain responsible for rational decision making. On demo, it says move your stop loss to where the structure dictates, and you listen. It says wait for the confirmation candle before entering. And you wait. It says the setup is not perfect, skip this one. And you skip it without regret. Here is a number that will change how you see all of this. Studies show that demo traders follow their own rules 74% of the time. The same traders on real money, they follow their rules only 31% of the time. Same strategy, same person, same chart, completely different behavior. This is the demo gap, and it is one of the least discussed problems in all of trading education. And the most dangerous part, most traders don't even realize it is happening to them. They are running on emotional autopilot, and they have no idea. I want you to pause right now and be honest with yourself. Were you disciplined on demo because you are naturally disciplined or because it costs you nothing? The moment you deposit real money, something biological happens in your brain. It is not dramatic at first. You open the platform, you see your balance. Real money, money that took you actual hours of work to earn. And now it is one trade away from being gone. And for a brief moment, everything feels fine. You find a setup. You analyze it carefully. Eurodollar is sitting right at the daily support level. Clean candle structure, bullish momentum. On demo, you would have entered immediately. Confident, no hesitation. But now you pause. Is this good enough? Should I wait for one more confirmation? You wait. The trade moves without you. You missed 40 pips. Does that sound familiar? Have you ever been so certain on demo but paralyzed on real money? The next setup appears. This one is even cleaner. You enter. The trade goes up 15 pips immediately. You start calculating your profits. Then it pulls back 5 pips. Suddenly you feel something new, a tension in your chest. On demo you would have held, trusted your stop loss, let the trade breathe. But now your finger hovers over the close button. What if it keeps going down? You close at plus 8 pips. The trade goes on to hit plus 65 pips without you. This is not a trading problem. This is a psychology problem. Your amygdala has just activated, and it has started overriding your strategy. The amygdala is the oldest part of your brain. It evolved to detect danger and trigger survival responses. To your amygdala, losing real money registers as a physical threat to your survival. Your heart rate increases, cortisol floods your system, your palms start sweating, and most importantly, your amygdala hijacks control away from your prefrontal cortex. The rational decision maker gets shut down. The panic mode survivor brain takes over. This is called amygdala hijack, and it happens to almost every new real money trader. Now here is what makes it even worse. The losses become personal. On demo you thought, I made a bad trade. On real money you think, I am bad at trading. Your identity gets attached to the outcome. Every loss feels like proof you are failing. This triggers shame, frustration, and a dangerous emotional state called tilt. Tilt is when you stop trading your strategy and start trading your emotions. You average down into a losing position because you refuse to accept you were wrong. You revenge trade after a loss because you want to win it back immediately. You overtrade because the adrenaline of being in the market feels better than watching it. Has any of this happened to you? If yes, you are not broken. You are human. Your brain is doing exactly what evolution built it to do. Protect you from loss. The problem is, evolution was not designed for trading. It was designed for survival. So we have identified the core problem. Now let us understand why it hits some traders harder than others. Before we go deeper into the science and the solution, I want to share something with you. On my Telegram channel at FXS Austin, I share real-time trade setups, psychology breakdowns, and everything I wish someone had told me before I blew my first real account. If you are in the stage between demo and real money, this is exactly where you need to be. It is completely free. The link is in the description below. Now, let us get back to the science of why this happens. There is a study from 2014 that permanently changed how I think about trading psychology. Researchers give two groups of traders identical charts and identical strategies. Group A traded with a demo account. Group B traded with real money. Brain scans showed that Group B has significantly higher amygdala activation on every single trade. Higher activation means more fear signals. More fear signals means less rational thinking. But here is the part that surprises most people. Group B had lower returns even on the same profitable setups. They were cutting winners short and letting losers run against every rule they knew. Their brains were prioritizing avoiding loss over capturing profit. This is called loss aversion, and it is hardwired into every human brain. Here is the most important number in all of trading psychology. Psychologists Kahneman and Tversky proved that losses feel twice as painful as equivalent gains feel good. Losing $100 hurts twice as much as winning $100 feels good, mathematically. So every time your trade is in a $50 drawdown, your brain experiences the emotional equivalent of a $100 loss. And you are supposed to hold. You are supposed to trust your stop. But your brain is screaming. This is why a 1 to 2 risk-reward trade that should feel logical feels like absolute torture when you are in it. I am about to describe 4 patterns that kill more real money traders than any strategy failure ever could. Pattern 1. Stop loss hunting paranoia. On demo, you set a stop at 30 pips and never moved it. On real money, you move it every time price gets close. Each time you move the stop, your brain gets a brief relief. You give it more room. But you are training yourself to break the most fundamental rule of trade management. Pattern 2. Premature profit taking. The target on your trade is 60 pips. The trade hits 25 pips in profit. You close it. Your brain calculates, if I close now, I guarantee the gain. If I hold, I might lose it. Loss aversion overrides your strategy. You take 25 pips when the setup was worth 60. Pattern 3. Over-analysis paralysis. You see a perfect setup on Eurodollar. Instead of entering, you spend 20 minutes second-guessing. You add more indicators. You look at more time frames. You check what other traders are saying. You are not looking for more information. You are looking for permission to avoid the risk. Pattern 4. The revenge trade. You just lost on a Eurodollar short. The position closed at your stop. Immediately you look for another trade. Not because you see a setup, because you want to make the money back. You enter a weak setup, you lose again. This is how traders blow accounts. Not in one big loss, in a series of small revenge trades that compound the damage. These 4 patterns are so predictable that experienced traders can almost set a clock to them. New real money trader, day 1, overconfident. Days 2 to 5, first losses, increased caution. Week 2, revenge trading begins. Week 3, account drawdown of 30 to 50%. Week 4, either quit or face the psychology. Most quit, only 10% come back and become consistently profitable. Think about that. 90% give up after the first psychological wall, but you are still here, which means you are already in the top 10% of people who ever tried. So how do you actually fix this? How do you cross the bridge from demo hero to real money trader? I want to give you a concrete framework, not generic advice, actual actionable steps. Step 1, understand that the goal of your first real account is not to make money. I know that sounds completely crazy, but stay with me for one moment. The goal of your first real account is to learn how to manage your emotions under real financial risk. That is a completely different objective, and it changes everything about how you experience every trade. If your goal is to make money, every loss feels like failure. Every drawdown feels catastrophic. If your goal is to learn your emotional reactions, every loss gives you valuable data. Okay, I felt fear at 15 pips of drawdown. That is my panic threshold. Now I know what to work on. Start with a small amount, not an amount that feels comfortable, an amount that feels completely irrelevant to you. If you are trading with $1,000 and losing 50 makes you sweat, that is too much risk for this stage. Think of your first real account as paying for a psychology education, because that is exactly what it is. Step 2, make your stop loss physically sacred. Write it down before you enter the trade. Say the level out loud. My stop is here. I will not move it. And then when price approaches your stop and every instinct tells you to move it, you must not move it. The pain of holding to your stop loss is the payment for building real discipline over time. Every time you hold your stop, you are rewiring your amygdala. You are teaching your brain to survive the loss. You are telling your nervous system, I can survive this. The strategy works over time. This is not a real threat. Step 3, use a trading journal, not a performance journal, a psychological journal. After every single trade, write, what did I feel before entering? During the trade, when I finally closed? Over time, you will start to see patterns in your emotional states that predict your worst trades. Every time I feel unusually excited about a trade, I am probably overtrading or chasing. Every time I feel afraid to enter a setup, I am probably looking at the best trade of the entire week. The journal becomes your personal early warning system for when emotion is overriding logic. Step 4, size down when you are in emotional drawdown. When you have lost 2 trades in a row, cut your position size in half for the next trade. When you have lost 3 in a row, cut it in half again, or simply stop trading for the rest of that day. This is not weakness. Professional traders at top hedge funds do exactly this as a structured protocol. It is called scaling down on tilt, and it is the most important risk management rule that nobody ever teaches you. Step 5, the 10-second rule before any emotional decision in the market. Whenever you feel the urge to move your stop, close your trade early, or enter a revenge trade, set a timer for 10 seconds. Just 10 seconds. During those 10 seconds, ask yourself, is this my strategy talking or is this my fear? 70% of the time, you will not execute the emotional decision after those 10 seconds have passed. The other 30%, you will execute it anyway, and that is still progress, because at least you were aware of what you were doing. Awareness is the first real step out of unconscious emotional trading. You cannot fix what you cannot see. Every professional trader you respect went through exactly what you are going through right now. The difference between them and the 90% who quit is not intelligence. It is not superior strategy knowledge. It is persistence through the psychological wall. That is the only real separator between those who make it and those who do not. They did not find a way to eliminate the fear. They found a way to act correctly despite the fear being there. That is the real skill, and it is completely learnable with practice and the right framework. You do not need to be fearless to be a successful trader. You need to be systematic when you are afraid. If you want to see how I personally apply all of this in real-life trades, come to my Telegram at FXS Austin. Every week, I share live setups on Eurodollar, gold, and other major pairs with my complete reasoning behind each trade. I also post psychological debriefs after big trades, both good and bad, so you can see my real thought process. It is completely free, no paid signals, no fake screenshots, just real trading, real psychology. Link in the description. Now for the most important part of this entire video. The demo hero and the real money coward are the same person. They have always been the same person. The difference is not skill. It is simply the presence or absence of real financial stakes activating your survival brain. When you understand that the transition from demo to real is a psychological journey, not a strategy upgrade, everything changes. You stop beating yourself up for panicking. You start studying your panic like a scientist studying data. You stop trying to suppress the fear. You start building the muscle to act correctly despite it being there. The market does not care about your demo results. The market tests your psychology, not your chart reading knowledge. Here's the truth that took me years to finally accept. The fear never fully goes away. Even experienced traders feel it. Even professionals on the biggest trades of their career feel the pressure. What changes is your relationship to that feeling. You learn to trade alongside the fear, not because of it and not despite it. The goal is not to become fearless. The goal is to become so systematic and disciplined that fear simply cannot change your decision.